So most people think that real estate investors make money by finding great deals. But the reality is a lot of the money made is actually by walking away from the wrong ones. Now, since last July, we've reviewed hundreds of multifamily and mobile home park opportunities across the countries. We've toured properties, we've spent weeks on diligence, reviewed inspection reports, market studies, talked to brokers, operator track records and backgrounds, and we've walked away from every single deal. And this is not because real estate is broken. It's actually a great asset class. But the number one item that kept failing in our diligence and underwriting kept us away from these deals. That number is market rent. So the apartment market is in a pretty unusual moment right now. And let's talk about why market rent kept being the defining factor of whether or not we did a deal in the last several months. Now, over the last few years, developers have built a huge amount of new multifamily supply while interest rates were low. And those buildings are being delivered now, or they've already been delivered and they're being leased up. So nationally, we're seeing one of the largest waves of apartment deliveries in the last 50 years. But the demand for apartments is still strong. Supply just temporarily outpaced it. So the result is that rent growth nationally has basically stalled. Some markets are flat, some markets are even slightly negative. A lot of the markets that see increasing demand trends just got a little bit overbuilt, and as a result, people are having to lower their rents a little bit to bring new tenants into the properties. But occupancy nationally is still healthy, around 94%, even though vacancy has ticked up a bit as these new buildings lease up. So this isn't a structural problem with housing, it's simply where we are in the real estate cycle today. But when you're underwriting deals, the cycle shows up very quickly and it shows up in market rent. So when we review a deal today, the first thing that we look at almost immediately, before the renovation plans or the exit assumptions or how much money could be made on the deal, we verify the actual market rents versus what's been underwriting. That's not the broker's opinion. That's definitely not what the sponsor puts on their pro forma. It's the actual rents that property is achieving on the market. So we go straight to the listings, apartments.com, Zillow, maybe other local leasing sites or the property manager's site, and we check a few basic things here. Number one is what units are actually leasing for today. Does that match what's in the spreadsheet from the sponsor? Two is how long units have been sitting on the market. If you're seeing something like 30 or 45 days, that's a decently long time, and it starts to suggest that maybe the asking rent could be a little bit too high for that market. And then the third is what kind of concessions are being offered. If you're seeing that they're offering 2 or 3 months of free rent, there could definitely be a concern there in that market having way too much supply or the market asking rent being way too high. So, we're talking about anything from free months to reduced deposits, discounted leases. Just because the deal claims rents of, let's say, $1,500, but comparable units might be leasing for $1,250, that really could change the entire composition of the deal, whether the sponsor says it does or not. And when you plug that real number for what actual market rents are in both what's asking and then also what rental comps are in the area, the math a lot of times, and especially in today's market, looks very different. So this has been the single biggest reason we've walked away from deals in pretty much the last year. The pro forma assumes rent growth or some lofty rent amount, but the market's showing something much softer. So we have to re-underwrite the deal based on current rents. And when you do that, debt coverage shrinks, cash flow disappears, exit assumptions get much more fragile. At that point, the responsible move for us has been pretty straightforward. We walk away. So even if you spent weeks on diligence toward the asset, like the operator, the approach really, it needs to always be the same thing. Protect the downside first. This is always our philosophy in what we do at Ocean Ridge, and everything else comes after that. Now, here's the really important nuance. Real estate is a hyper-localized asset, and the supply story looks different depending on markets and even where you are in a certain market. Basically, Section 8 and affordable housing, we recently exited a fund in Cleveland where we started in 2020 to buy 20 different multifamily properties properties. We turned them all from distressed into thriving affordable housing units, and Cleveland has actually seen some of the strongest rent growth in more than 30 years. Now, the reason is based on supply, because Cleveland didn't build much new supply. Developers were focused on building out places like the Sun Belt and not so much places that have kind of moderate to no population growth. So demand actually kept pushing rents higher, basically with no new supply coming online. Meanwhile, a lot of the Sun Belt markets that built aggressively are absorbing units, right now, and that's actually hurting their rent growth. So as a result, our fund was a major beneficiary of the increase in rents, and we were able to sell at a really good multiple for the investors. So think about it, same asset class, different rent dynamics, and this is why market selection matters so much. When we put it all together, what's interesting is kind of where we go from here, because supply is, relatively high in some corners, but new construction is falling quickly. I mean, I've done videos on this before, but I mean, we're in an environment where there's something like 60 to 70% less new housing in construction than there was 3 years ago. And high interest rates have made development much, much harder, which then prevents projects from penciling, makes financing more expensive, and multifamily construction is just simply starting to grind to a halt as these deliveries kind of work their way through the system. So this is going to mean that a few years from now, we could easily have the exact opposite problem in some of these higher demand markets where supply is getting absorbed and no new supply is coming online. And when that happens, rents tend to move relatively quickly. That's just how these cycles work. So the opportunity right now isn't about chasing aggressive projections. It's about buying assets that work under today's rent, but also will work into tomorrow. If a deal works with just opportunistic rent growth, we always pass. But if it works conservatively today and the operator is strong and the long-term setup is attractive, maybe we're in, despite, looking into other parts of diligence. This is an interesting and opportunistic time right now to buy multifamily real estate, and these cycles eventually do normalize. At this point, especially with where stock premiums are and the sort of the valuation we're seeing in other parts of the market, I think the dislocation in multifamily is setting up for one of the best buying opportunities in our generation. And we're really looking opportunistically right now at this being the critical moment to start getting into some new allocations. So if you are evaluating a real estate deal today, the first question I would ask before you look at anything like the IRR, the renovation plan, the upside, is what rents are tenants actually paying and what did they underwrite? Verify it for yourself. Check the listing, see how long things are sitting, check the concessions, underwrite the deal based on today's reality, not the sponsor's projection. Because if the deal works there, you might have something durable that's going to make you a lot of money. But if it works with perfect rent growth and assumptions, that's a totally different level of risk. In summary, real estate has always been cyclical. Right now, we're in a moment where discipline matters a lot. For us, that means walking away from a lot of deals. But that's part of the job. That's part of capital protection. And because ultimately the best investment decisions you can make sometimes are the ones where you say no. So let me know your thoughts in the comments. Let's stay in touch.